We'll be talking about a popular reverse pattern, which is the most dominant reverse pattern, heads and shoulders pattern. So in the table of contents, we're going to look into the introduction to head and shoulders pattern, how to identify this head and shoulder pattern, the trading strategies for head and shoulder pattern, how you can recognize an inverse head and shoulders, which is the opposite head and shoulders, trading strategies for this inverse head and shoulders, and comparing head and shoulders with the inverse head and shoulders, with its advantages, limitations, and tips for effective use. So, what is head and shoulders? Head and shoulders is a popular reverse chart pattern, like a double top and a double bottom. A head and shoulder is the most dominant reversal chart pattern you can find in a bigger time frame or a pair with high volatility. So you'll be looking for chart patterns, head and shoulder chart patterns in 1 hour charts, 4 hour charts, and more. You don't find them in 15 minutes, you don't find them in 10 or 5 minutes because it takes a long time for it to form. And it has to go to for an extensive amount of period for the price to come down. So the key components to head and shoulders, we have a higher high, a higher low, a new higher high, an equal low, and a new lower high. And for the inverse head and shoulders, we have a lower low, a higher high, a new lower low, an equal high, and a new higher low. So this is a typical graph pattern in the gold, which is of high volatility in an hour chart. You can see a typical head and shoulder pattern. So you can see the left shoulder, the head, and the right shoulder. And we can see the neckline, which is the support. So the key signs to take this reverse chart patterns are a high, it has to be high above the moving average. You can see the 200 period moving average as the blue line. You can see the price has scaled way above the 200 moving average. It means the price has gone to its premium. It has gone extensively over a regular price or regular amount. So price is bound to reverse. And when you're looking for these reversals, you're going to find a double top, a double bottom, and head and shoulders. Head and shoulders are the ones with the maximum effects of reversing. It takes a huge amount of pushback. So another sign is a great strength to the direction towards the present trend. As you can see, we're in an uptrend and it's high above the moving average, which is 1 point. And the second point you can see is way above the moving average. So there's a great strength towards the upside. That's where you can find an identification for a head and shoulder pattern. And thirdly, you're going to see a weak pullback, which is on the left shoulder to its support. And then you're going to see a greater height achieved after this pullback. So an extensive push more. And then you can find an exhaustion for the next pullback, and then a weaker one following up, which is the right shoulder. Then after that, it comes back to the support and breaks the support because there's no longer buyers to push the market further. And then it finds a resistance from the support zone and the price crashes. So for a head and shoulders, you take your entry on the neckline, slightly below the neckline, and have your stop loss above the right shoulder for a conservative entry, and have your take profits from where the push originated from. This is how you take your entries, your stop loss, and your take profits when trading a head and shoulder pattern. So when to avoid head and shoulder chart patterns? 1, you don't trade against the moving average, support or resistance, because prices are drawn to this moving average, and you don't trade against a psychological support and resistance. If there is a price or a resistance or a support opposing the direction of this head and shoulders, you should best avoid the head and shoulders. But although head and shoulders are very strong and could obviously fight this structural or resistance bias, it's only best you trade this head and shoulders when it's very visible. As you can see on the chart, it's wide apart as of compared to the other head and shoulders you saw. The shoulders is not really dominant, and you cannot classify this as a head and shoulder. So it has to be very visible. You shouldn't trade against the moving average, and you should also check for psychological support and resistance before you trade such areas or such patterns. Now, the inverse head and shoulder chart patterns are just the opposite, or an upside down graph of a head and shoulders, because it's the same head and shoulders. As you can see, the price has its high below or away from the moving average, which is the first point. You can see the distance between the moving average and the length of which the price fell. And then the second sign is a great strength to the direction towards the present trend. You can see the price pushing downwards in a higher level with a higher speed and higher momentum. There's obviously going to be bound for a pullback. And now this pullback comes and creates a secondary resistance, which is weak. So it doesn't change the amount or the strength at which the price has gone. The price has pushed through. It takes a minimum amount of it, and then it finds a resistance and pushes it way further down below, creating a new low, a very big low, and then has another pullback towards the initial resistance, and then the resistance pushes it down again. And then it creates a minor support, which is lower, but not to the length of the major pullback, and then goes back to the resistance and then turns the resistance to a support. Automatically, you'll be looking for an entry in the neckline, like I said. You have your stop loss below the right shoulder, and then take profit where the initial beginning of the momentum takes place. And then take profit 2 is the initial ride off the trend, which most likely it's always advisable to take profit 1 and adjust your stop loss to break even. Now, when to avoid an inverse head and shoulder chart pattern is the same thing. If the head and shoulders, it's not visible, if it's not obvious, it's not there. You have to make sure that the head and shoulder is visible to the eyes. You don't want to force the head and shoulders to be there. You don't want to convince yourself that the head and shoulders are there. If it's not there, it is not there. The head must be very much visible. It should have a very clear indication that it's a head. And if it's a clear indication, it has to be a very big push, a very big difference between its left shoulder and the right shoulder to its head. So the head and shoulder patterns are reverse patterns, not continuation patterns. So you're only trading an inverse head and shoulders in a downtrend and a head and shoulders in an uptrend. You don't trade inverse head and shoulders in an uptrend. It is not a trend continuation. So if you are mistakenly seeing a head and shoulders in an uptrend, you shouldn't take it, because they are reverse patterns. And if you're seeing a head and shoulders in a downtrend, you shouldn't take it, because heads and shoulders are reverse patterns. And head and shoulders are found at the premium and discount levels of price. So it means that you find a reversal at the premium, which is the highest level at which the buyers and sellers want to take the price, and the lowest level at which the buyers and sellers want to take the price. You don't find head and shoulders in the middle of a trend. It has to have accumulated an extensive amount of height before a head and shoulder pattern is visible. So there has to be a great push in the market. And that is why I say you find them in an hour, 4-hour time frame, or liquidity pairs or currency with a high momentum. Now, the key signs to take in a reverse pattern like this: we have your left shoulder, we have the head, we have the right shoulder, we have the support and resistance, and then we have the entry. And when you look at the RSI, you can see that although the head is way higher than the left shoulder and the right shoulder, you can still see a weakness in strength, because the RSI is a momentum. I've always explained to you, it's always good to have a momentum indicator so it could confirm your bias of the strength in the market of the buyers or the sellers. So as you can see, although the head was way high and it felt like the price skyrockets, you can see that it's on the head, you can see the momentum shows is low. So it means that the buying pressure was gone. So you can tell that automatically the price is going to reverse and fall. So it confirms that yes, if I take my entry at my support level, the price is bound to fall and I wouldn't lose my money, and then you take profits. Same thing with the inverse head and shoulder chart pattern. You look for your head and shoulders, you find your left shoulders, you find the head, you find your right shoulder, you check for your neckline, for your entry, and then you confirm with the RSI and see the momentum. You can see there's this incline to go up. You can see the price has shifted from its discount, which is minus 30, and goes up to 50% zone. So it shows that there's an influx of buyers in the market. So you can tell that if you take your entry on the resistance turn support level, the price is bound to push above. And with the price going on top of the moving average, which I said if it's on top of a moving average is a buy zone. So it means that it's a strong bullish, and you can see we have a take profit 1 and a take profit 2. So it's simple, guys. This is how you can trade an inverse head and shoulders and trade a head and shoulders. So there's no, like I said in the previous double top class, there is no indicator for this. So it's all about drawing your graph up, looking for these zones, looking for these price actions, and identifying your entries and exit correctly. So thank you. I'll see you in the next class.